Hi, it's Harry Dent with a second update here in mid-January for the markets. We've been saying, obviously, for years that this bubble will burst. All bubbles burst. End of story. Any economist says this is not a bubble, is not comparing it to past bubbles, is not looking at overvaluation statistics, that when you look at all of them, we're extremely overvalued. There's a few exceptions, but extremely overvalued overall. Very much like 1929 and only a little less than the greatest bubble in all of modern history, the tech bubble that peaked in early 2000. This bubble is set to burst, but it needs a trigger. The last bubble was triggered by the housing bubble bursting and triggering a subprime debt crisis. Nobody saw that coming. They saw how prices going down, but everybody poo-pooed it. The market ignored it at first in early to mid-2008. Bernanke said everything's okay. Home prices kept going down. Subprime loans started defaulting. Boom, that triggered all types of debt defaults and debt concerns, and we had a global financial crisis from four states having a subprime crisis: California, Arizona, Nevada, Florida. Triggered a global bubble. Why? We had unprecedented debt and slowing demographics in key countries now like the United States. Well, this is the next bubble, much greater than 2007, much steeper. What's going to trigger it? I now think falling oil prices is the trigger. We had a fracking bubble, very similar. This time it was high-yield bonds and leveraged loans partially to the energy sector. 15 to 20% of this kind of debt, high-risk debt, was to the frackers and energy drillers. This is failing. Oil prices traded sideways for a number of years and now fell out of that sideways range between 80 and 115. Oil originally peaked at 147 in 2008. By the way, dropped 80% in 4.5 months, faster than any market in history. Why? Because of leveraged traders and hedge funds buying this stuff, bidding it up crazy, and then when it drops, they got margin calls and it drops like a rock. That's how bubbles burst. The steeper they are, the faster they burst, and the harder they burst. That was the first drop. Now we're in the second drop. Now that we've gone out of this range, it is very unlikely we'll break back up higher than 80. Under $80, frackers are dead. Most frackers are dead. Under 55, they're all dead. There will be no more fracking. The existing wells will continue to pump out until they go dry in 2 years in total, and say about a year on average if you average them all out. For the next year, you're still going to have supply going with slowing global demand and continued falling commodity prices, and oil is going to fall further. The only question I have, does oil bounce here? You know, in mid-January, we're talking about 44, 45 bucks. Does it just keep going straight down to 32? If that happens, stocks are going to peak earlier. This crash is going to start earlier. I think it's a little more likely that oil bounces back to 64 to 76, somewhere in that range, and then turns around and crashes. The only support for oil here, at least intraday, was the low of $32 back in late 2008. We go to 32 bucks, it's going to be even more obvious that we're never going back to 80, or not for a long time. A lot of people still think we're going back to 80, 100 plus. Even Boone Pickens think that. We do not think that. Oil is the trigger because it goes down. The fracking debt, $500 billion, starts to go bust. That high-yield bonds continue to crash because once any sector of the high-yield bonds or debt goes bad, the bondholders start worrying about all debt. And all high-yield bond is going to, the bonds have been pricing like there's no risk. High-yield bonds, get this, went to as low as 5% in 2014. 5% for risky debt. The lowest those yields got in the 2007 boom, when everything looked hunky-dory, was 7.5% to 8%. And in normal times, 10% is more what these bonds should be yielding. So fracking was the product of two things, which were both the product of unprecedented stimulus. We would not have seen oil prices bounce from $32 back to as high as 115 if we had not had $10 trillion in money printed around the world. We would not have seen frackers be as profitable if they had to borrow money at 8 to 10% for this high-risk stuff instead of 5 to 5.5%. So fracking was a bubble created by the bubble in quantitative easing, in QE. It wasn't a long-term innovation. And we were told this was a major innovation. It's going to make the U.S. oil and energy interdependent and it's created 1 million jobs and made states like Texas and Dakota and North Dakota, unbelievable growth state. This is all over. So falling energy prices triggers the fracking bubble to burst. That triggers other higher yield debt and leveraged loans to burst, and then we get a negative feedback cycle just like we got in 2008. The difference is we have more debt than we had in 2007 and 8, more debt to deleverage. The demographics are going to get much weaker, and in many more countries, Germany is going to dive off a cliff. Southern Europe following it, France, all these countries. China is already seeing its workforce growth slow, and at some point in the future it actually goes down faster. Demographics are only going to be worse. The U.S. is going to see its 20% affluent consumers, who are still spending more than ever, unlike the average Joe, collapse because they peak at age 53 instead of 46, like everyday people did in 2007. Demographics are going to get worse, debt is higher than ever, and now we got a new trigger in town, falling oil prices. The fracking bubble is going to be the subprime crisis of 2015. And when do we think this is most likely to happen? Our best cycles, and we're always only guessing in the short term, say stocks are most likely to peak mid to late March and crash into 2015 and 16. And you know our targets on the broader pattern. The next stop is 5,500 to 6,000 or so on the Dow. Ultimately could go lower. The next low, which on this trigger in the oil, is probably $32, a little bit higher, maybe a little lower. Ultimately, oil is going to go to 10 to 20. Gold should bounce, but then it's going to go down. Next stop, 700. So again, we've been seeing this emerging market and commodity collapse, and that is becoming the key trigger, and nobody has been looking for that. We're going to keep watching oil prices. We're going to keep watching the S&P, and we're going to be looking for some sort of turn date, likely around mid to late March. Thanks for listening.